Hello friends, welcome to our channel. Today we are going to discuss a new topic, Adjusted Tangible Net Worth, ATNW. First we will discuss net worth. Net worth provides a clear snapshot of an individual's or entity's financial position. It is determined by subtracting total liabilities, what is owed, from total assets, what is owned. Positive net worth reflects financial strength, while a negative one indicates that liabilities surpass assets, signaling the need for better debt management and financial planning. Tangible net worth. TNW represents the company's actual physical or tangible assets minus its total liabilities, excluding non physical assets such as goodwill, patents, and trademarks. Adjusted tangible net worth. ATNW is a refined version of TNW, commonly used in credit risk assessment. It adjusts TNW by including quasi-equity components and deducting loans or advances to related parties and subsidiaries. Fund invested outside business, FIOB. This provides a more accurate view of the company's genuine capital base relative to its total debts and obligations. Net worth equals total assets minus total liabilities, or net worth equals share capital plus reserves and surplus. Tangible net worth equals total assets minus total liabilities minus intangible assets, or tangible net worth equals share capital plus reserves and surplus minus intangible assets. Adjusted tangible net worth equals share capital plus reserves and surplus minus intangible assets minus fund invested outside business, FIOB. Credit risk assessment. Banks and financial institutions use ATNW as a key benchmark to evaluate a company's financial strength and leverage by comparing it with total outside liabilities, TOL. Financial health. Higher ATNW in relation to TOL reflects a solid capital base, financial stability, and a lower likelihood of default or insolvency. Decision making. Knowing your ATNW enables better financial planning and decision making related to investments, savings, and debt management. Adjusted Tangible Net Worth, ATNW, is an enhanced measure of a company's equity, designed to provide a clearer picture of financial strength and risk. It is often used in calculating leverage ratios such as the debt to equity (DE) ratio, offering a more accurate assessment of financial risk within the banking and credit evaluation process. By excluding illiquid items such as investments in subsidiaries and long overdue debtors, ATNW reflects a more reliable equity base. This results in a DE ratio that more accurately represents the company's true capacity to manage debt and sustain financial stress. Let's assume the following financial details of Messrs. ABC Private Limited. Ltd. Amount in rupees. Share capital is 80 lakhs. Reserves and surplus 40 lakhs. Intangible assets, goodwill, patents, etc. is 10 lakhs. Investments in subsidiaries is 5 lakhs. Loans and advances to related parties 5 lakhs. Promoters unsecured loan treated as quasi-equity 10 lakhs. First, we calculate tangible net worth, TNW. TNW is equals to share capital plus reserves and surplus minus intangible assets, which is 110 lakhs. Step 2. Calculation for adjust tangible net worth. ATNW is equals to TNW plus quasi-equity minus investments in subsidiaries plus loans to related parties, which is also 110 lakhs. Interpretation. The company's ATNW of 1.1 crore rupees represents its true tangible equity base after removing illiquid components and including quasi-equity, providing a more realistic measure of its financial strength. Higher ATNW indicates a solid capital foundation and a greater capacity to withstand financial losses or stress. Lower ATNW may point to excessive debt, over-leveraging, or possible challenges in maintaining solvency and financial stability. Thanks for watching. Don't forget to like, share, and subscribe.